I probably look at this a little bit differently than other people. It's
Hmm.
part of it's the way I look at in the emergency department. I split up the benefits, the living benefits, into fun, not so fun, and kind of fun, right? So
Hello, hello. Welcome back to the Legacy Engineers RX podcast. I have the pleasure again to be with your co-host, Mr. Paul McHale. Hey, Paul, how you doing, brother?
I'm good, David. How about yourself today?
I'm doing good, man. Good end of the day. Ready to share a drink and some ideas with you, my friend.
Yeah, it's been a good week. It's been a little warm week. We live down here in the Phoenix metro, and I think we had a few days in the 116, 117 range. So
Yep.
it's nice to be inside air conditioning. It's nice to be, as our promise for those who watched the first podcast, suggesting a drink. I believe our good friend Joshua had the first. I think it was an IPA and Cabernet. I think we both
Mhm.
chose the IPA over the.
Yeah.
I'll switch to a Cabernet when it's less than 100 degrees outside. But Josh, here's to you, brother.
Thank you, brother.
Yeah, what do you want to talk about today? I know we've talked the first week. We kind of gave our stories of how we got into this. Last week, we spent some time talking about insurance itself, right? Kind of going into it. Today, what you in the mood for?
I think a natural place to go, like since we've established those two things, is like, okay, now that we said in the last episode, hey, most people buy life insurance as if it was called death insurance. What if we actually set the table for why is it called life insurance?
Life insurance.
What are the living benefits that we see in this asset class? You and I have used this in multiple ways, in different ways. We have our own perspectives, our own ways to organize those ideas in our minds. So I think in a conversation, we're going to put together probably a nice list of benefits
Yeah,
that will be helpful for anyone listening to find ways to relate and mind and find
yeah.
the asset class valuable. So I think we should just go after a benefits conversation. We're going to be talking about living benefits. So now we're moving into the permanent insurance, more importantly,
Yeah,
the
I was gonna
whole
say,
life
right? Because
part of it.
term insurance, you don't have living benefits. You got one thing, death benefit. It's priced
Correct.
perfectly for that, but you don't have the ability to use it on anything more than I've got a piece of paper in case I die, and the insurance company will cover my risk for my family, my earnings, my future human capital. So
Right.
the living benefits, and I probably look at this a little bit differently than other people. It's
Hmm.
part of it's the way I look at in the emergency department. I split up the benefits, the living benefits, into fun, not so fun, and kind of fun, right? So I like to look at things in that manner, right? And kind of just broad stroking, the not so fun, but probably the most important. You've got accelerated, you've got chronic illness riders, disability riders,
Yeah.
accelerated death benefit riders, and those are separate riders within the policy, so they allow you to enact and receive some of the benefits of your death benefit ahead of time. So
Yeah.
chronic illness, if you're diagnosed with Parkinson's or ALS, other chronic diseases where you are unable to perform what we call in medicine the ADLs, activities of daily living. There's six of them. They're transferring their continence, they're getting dressed, they're feeding yourself. Most insurance companies, I think it's rather if you can't perform two out of six after 90 days, then you benefit for those. And the
Hmm.
cool thing is that if you have $1 million death benefit, and say you're 75, you've had a stroke, and now you're really having a difficult time caring for yourself, you can access part of that policy somewhere. So I know some of the companies will get up into the 90s, but most of them I think are in that 30 to 70% range as far as being able to access that death benefit. So you're able to get that money ahead of time, help, get your home situation, get home health. And those are all similar policies, but obviously different reasons. There's terminal illness, right? So if you have terminal cancer, you can really accelerate your death benefit. And think about, that's why I say it's not so fun, but it's probably the most impactful. Think about someone who, we see this, right? Well, one of the worst parts of being an ER doc is diagnosing cancer. It's an absolute gut punch to the patient.
Yeah.
They almost never go into the emergency department thinking they have cancer. The worst cases are the ones where, it'll be a 35-year-old that comes in for belly pain and you CT and they've got Mets everywhere. And, there's always hope, but you're delivering horrible news. And say it's bad enough where they have less than a year to live. How much, I don't think you can place the importance on that person being able to look at their family and say, can accelerate our death benefit. Let's go on. The trip that we've always talked about, let's not worry about money. You don't have to worry about going to work, and let's encircle and spend the last year that we have together in a meaningful manner. And I wish there was a study on this, because my hunch is that also lets patients live longer. There's a lot of research out there in medicine that stress and all those worries that happen when you get a chronic illness, they probably accelerate our demise. And I think there's probably some additional benefit of living longer when you are really able to take part and receive some of these benefits.
Yeah. It's great that you started there, and I've never classified as not fun, but the way you're talking about it, I can tell you the way I think about it is, God, I'm lucky that I have not had to have this conversation or exercise that rider with any client.
I was going to ask you
And
if you have yet.
never have. I've heard of people that have, some people on our team has, and they've supported clients to get experimental treatments in outside the United States, or a life celebration is another example that I've heard. But what you're saying there is like the ability to create space,
Yeah.
not just physically and time wise, but like emotionally. I don't have to be going to work, and we can truly maximize the 6 months to get. Just when you were talking about that, I kept thinking, man, when this happened to my family, and I thought about my mom, like
Your mom.
we still were going to school, my dad had to work, and back in being a family in the hospital, like, and it's such a blur because we never create a space to really enjoy that time together.
Yeah.
We couldn't even embrace it or accept it. So I can imagine that, although I don't want anyone, and I don't wish on anyone having to exercise this, what a blessing to be able to have an asset that allows you to create the opportunity to enjoy each other fully present. And it would be fascinating to see research that says that they get an extra several months because the quality of time they got allowed them to be
Yeah.
in a better place.
The reason why, so I think it's New York Life, in one of their throwaways, had a story of a gentleman that was diagnosed with terminal cancer. And the story didn't exactly say if he was still living, but the story did say that he's made many more milestones than initially thought, right?
Mm,
That just made me think of that possibility. We know, right? We know this heals the body. We
yeah.
don't quite understand how, and some doctors still think it's a lot of voodoo, and other doctors are very much into it. There's probably truth in the middle, but if I'm in that situation, holy smokes, to not have to worry. Imagine being the spouse of your partner, terminal cancer, and you got to go do your 9 to 5.
Oof,
That's,
brutal,
yeah. I mean, I think
brutal.
about your dad, right? Putting on his
Teaching a
pants, going to
class.
work every day. Yeah, yeah.
Yeah, teaching a class in a university. I cannot imagine what that was like before, after. Yeah, absolutely. And uh, like the engineer in me also thinks like, what a fascinating idea to have an asset class that works in every scenario. I don't know if you've ever thought about that, but in the scenario where this works, and we never have to exercise this rider, we're going to talk about the fun benefits. These things are with you your entire life, providing you those benefits all the time, every day until you're no longer here. In the scenario where you have a really, unfortunate situation, and you know this better than me, but the country is moving towards that, having a larger portion of the population having chronic illness and terminal
Yeah,
illness
yeah.
and long-term
Big,
care,
it's
all
a
these things,
giant
right?
issue. The cost of
So
long-term care is brutal. Not only that, not only do you have the cost, you have the real concern about those companies being around,
mhm,
right? Because the initial companies that started long-term care insurance are out of the business, and it's a difficult business because probably 20 years ago they weren't planning on where the acceleration of the cost of medicine and the cost of what healthcare has become.
yeah,
Um,
yeah,
and
yeah.
here's here's a way to buy lots of coverage for pennies on the dollar, right? And not have to deal with does it qualify or not? Because that's the other tricky part that's
Mm,
been going on that's written with some of the long-term cares. Sometimes the coverage is funneled down and you qualify, you don't qualify, and there's that argument. I think it's probably much more of a generic, you either qualify or you don't, not necessarily what illness, what issues. But
yeah.
certainly, the accelerated death benefit doesn't exist. I mean, those are just, like you said, it is a product that really solves a lot of problems, and it's not the king of half-ass. It doesn't, so it's one of my dad's like favorite sayings, and I keep it with me, but it doesn't do things poorly. The ability to have that coverage and use it and get a large part of your death benefit, that's fantastic, right? So it's not like the insurance company is putting a limiter on what those benefits actually give you.
Yeah.
It really does some of those things fantastically. You hope you
Yeah.
never have to use them, right? You hope you don't have to go into the not fun category, but if you
Yeah.
do, it's always good to have that. My
You know,
my dog, in case you're hearing whining, is talking right now. Pergy,
we
you
have a
understand.
we have a third podcaster today on the show. I love it.
Yes, we do.
Uh, we had the opportunity to be in front of the leadership of one of the largest insurance companies we're in partnership with, and I don't know if you remember this, but when this conversation about these benefits we're calling not so fun, right, are there, the response we heard from the leadership was, we're in the business of providing liquidity, and we're gonna push that liquidity. And when most people want to hold money, all their financial services, assets under management services, all these people want to hold on to your assets. Life insurance companies are in the business of pushing that liquidity out, and they don't mind whether they do it earlier before you leave through some of these riders or after you're here. They guarantee that your family would have that liquidity event. The timing of it is available because they're constantly matching these
They've
assets and
matched, right?
liabilities
Yeah, they've matched.
throughout their lifetime, and they have the ability again to guarantee the existence of that support, that liquidity. So it's a fascinating thought, and it makes me think about why banks, at the end of the day, tier one capital goes to entities that behave like that, completely opposite to their model in the
Right.
banking system. So really, really, really
Yeah.
interesting. Any other things that you throw in the bucket for not so fun?
No, I mean those to me are the big ones for not so fun. So that's kind of where I have that bucket. The next bucket is the kind of fun, and
Mhm.
I love the privacy, creditor protection as a physician, lawsuit protection. Right? We all there's a lot of great big lawsuits out there. I think for the privacy, it's nice to have a large part of your foundational wealth that's not known to either the public, not known to banks, not known to your creditors, right? It is, I call it my own private Idaho. And I think, some people would probably say that's either fun or not. I mean, but to me, it's in the middle as far as that category. And it was kind of an outlier, so I created the not so fun category for that. I do think it's a very powerful tool to have. Um, the fact that you can have a separate loan system, and we'll get into kind of the fun part, family banking in the future, but as our middle kiddo starts approaching buying her first house, kind of excited to use that. She'll have
Mm,
a house, but then, her she'll have her typical credit cards and everything, but when she goes to perhaps buy an investment property, they're not going to look and say, well, you already have a loan on your income. That's going to be private, and a private contract with our own family bank, which she'll obviously be able to make those payments. But those type of things are really kind of cool. And I think as credit, obviously, if the economy goes a little bit south, credit gets tight, and credit, it's sometimes very hard to get credit. And if you have any sort of that debt to income ratio is out of whack a little bit, you're not going to get it. And I think that's kind of a great, fantastic little part of the puzzle as well. What's your thought?
Yeah. Yeah, privacy is fascinating. A little parenthesis in what you said there is funny because it makes me think of when I first came to the United States, I showed up to one of the large banks and, I'd like to create an account. Great. And I'd like to access some credit. Well, you don't have any credit history. We cannot extend you credit. And my question to the manager was like, how do you develop credit history if you cannot access it because you don't have credit history? And it's a fascinating conversation there, but yes, to your point, the privacy is one of those. I would actually think that that straddles pretty hard the line of fun. If you think about it, especially in the world we live today,
Yeah.
open YouTube and look at the videos and try to figure out whether it was made with AI or not. And a lot of times, it's getting very scary how difficult it's going to be discerning truth from not. And in that world, I think privacy is going to start to play a bigger role in people's mind. How do I protect um, the transparency of where my are stored, particularly my liquidity. So I think privacy is fascinating. What we're talking about is when you have a life insurance contract, it's a private contract between you and the insurance company,
Yep.
unilateral contract. And because it's private, no one knows how much cash value you own or how
Yep.
much death benefit you own or whether you take a loan or surrender some of this money, right? Your CPA will not know and will not include in your filings of your taxes any of the assets, the growth associated to life insurance because it's not an investment. It is a vehicle for protection. Paul, when you pass, that death benefit distribution to your beneficiaries is off the record. It is private. The amount and the distribution is not part of public record.
Yep.
When you take policy loans, they're not part of your credit reporting. So I'm listing a bunch of things that are really important because in the
And
very
I'm gonna just interrupt. Is the great thing is though that even though it's off those reports, from a tax purpose, you can still use. So if you're using it for a business loan and you create a standard paperwork business loan and interest cost, you can use those interest costs as a deduction against your business. So you still have the ability to use it in a way that it actually helps your taxes. But to your point, it's not exactly mentioned on your CPA, on your debt service report, or your
yeah.
underlying spreadsheet.
Yeah, we should talk. We should definitely have an episode when we talk about business uses and that banking activity as a business, because I think between you, the individual, and the business, you can establish a way to communicate and move that money where it definitely can support your tax strategy. I agree 100%. But more broadly for the regular individual, the doctor, the engineer, the professional, the person. Imagine having a portion of your balance sheet that has a blurred line on top of it and is private just to you and whoever you want to let know that you have that asset.
Yeah,
It offers a bail of protection. It's regulated state by state, so we encourage you all to learn what the regulations are for your state. But there may be some creditor protection, for example,
yeah.
protection
In,
through that privacy.
in Arizona, there is. I know it varies.
Hmm.
Every state varies a little bit, but definitely exists
Yep.
in Arizona.
Yep. It may offer also, in addition to that, some benefits when you go access other types of debt or other types of credit. The perfect example I give to people, which relates to a lot of families, is this. If you have a 15-year-old, a 12-year-old, a 16-year-old, whatever, planning to go to school, my 4 and 2-year-old boys,
Yeah,
right?
yeah.
At some point, if they decide to go to formal university and they decide to finance some of that education through a student loan, that FAFSA application will not count the assets I have under my policies and the policies of my children. And you're about to raise your hand, which is
I've
you're
I've
about to
got
tell
a
us you've done this.
I had that very issue when Sammy was going off to A&M first year, and you apply for grants and scholarships, and uh, completely denied because we had built up 529 plans, and
Yeah,
there was a decent amount of we had bull market behind us, right? So
you're a great saver.
it
Yeah,
was
you're
it
a
was
great saver.
great for 20 years, and when I realized, I'm like, so grants and scholarships, and there's a little bit of the discussion, which I think is a fair discussion to have. It's another one of, should you be eligible to receive grants and scholarships based upon income. We're a high income family. the way I land on that is we pay a lot of taxes. I feel like, yes, if the student is eligible, then the student should be eligible. And in the end, all of our kids are, helping pay for their college. So to me, it's her efforts. And if she got, great GPA in high school and is one of those kids where the college says, we want to give you a grant, then I think she should get it. But she didn't get it. So after freshman year, her 529 got cashed, and then Riley's, our younger daughter's 529 got cashed. And we've had policies with them, but they don't have 529s anymore.
Yeah, yeah. And nothing wrong against the
No.
asset.
And
I
by the
think
way, I don't
that
think we've said this isn't tax or investment advice.
yeah, it'll be in the show notes. I promise you that. But I'll tell you, like what you're saying brings up the question. Like you pair what you're saying there. You're a great server. You and your wife have been great savers for the family, and the habit alone is wonderful. But it also has an impact in which, in the manner in when you decide where to store those savings.
Yeah,
That asset that you use to park that money, to put that money, and
yeah.
then make use of that money will have things that a lot of people do not anticipate that will help make them regret those decisions or then see the value of what. So I think of privacy as a really, really important thing that people don't know how to, they don't know how to put the value of privacy in their balance sheet, but they intuitively feel,
Feel it.
I'm glad that there's this protection veil in the
And,
policy.
and I've told this story before, but even though it's private, banks are very well aware of it. And, we can get into this later, but banks, even though they have it themselves. So when you can present to any commercial bank with a policy that has a large cash value, and the bank will absolutely appreciate that as a asset on your balance sheet, even though it is technically hidden from their credit reports.
Likely they own the same amount plus three more
So
zeros to the right
yeah,
than you.
everybody's
So
president in the
they will likely recognize it immediately. The privacy will not hold them back from seeing that this pristine collateral they use themselves. Absolutely.
yeah.
Okay, so privacy is one. What else do you have in that bucket?
So that's the only thing I've got in the kind of fun bucket. And
Interesting.
now we're deep into the fun bucket.
Yeah, yeah.
And
I'll have a
yeah,
suggestion for that line in between.
okay, all right.
Let
What
me
you
let
got?
me tell you one thing. I think people also don't think this as super fun, so I'll put it in the middle bucket. But the guarantees part of it, I
Okay.
think is it's a really, really important part of this. Privacy and guarantees actually is what makes the entire thing possible. I know we're moving towards the fun, and that will be
Yeah.
the
That
good
was my number
conversation.
one, damn, it's fun thing. So
Oh,
please,
really?
yeah, yeah, oh yeah. Yeah.
Interesting. Wow. Let's
Yeah,
let's
yeah,
jump right in because
yeah.
then it's exactly what I was saying. Like to me, it's in that line, like that's how we transition to the fun. Guarantees in this thing, man, think about this. I always tell people, think about everything you own in your balance sheet. Any of those things come with a receipt that says guarantees. It doesn't matter if you own stocks, bonds, crypto, real estate, interest in a company. I always joke that you can put a hole in a Swiss mountain and fill it with gold, and it will not come with the word guarantees, right?
Right. Yeah. No,
So how do you think about those guarantees?
I think so. This is the way I thought of it. And I was talking to a friend of mine today, and we were talking about, owning passive generating income, or owning assets that generate passive income. And like real estate's the classic example, right? You go buy a $150,000 house, and that generates a $1,200 a month check, whether or not you have a loan on the house or not, right? You can tweak your return.
Cash flow. Yeah.
But in the end, you pay, if you're paying a property manager, it's still generating a cash flow, quote, the mailbox money. And I think a game that we all need to get better at, because the Kiyosaki will say, once your passive income exceeds your spending, then you're financially free. And I think there's a lot of truth to that. So does my dog. Yes, Fergie. But this to me is, and I really didn't think about it until today. This is the easiest way to get a passive income asset, right? Because there is a guaranteed policy increase dividend. The dividend's not guaranteed, but there's a contractually guaranteed increase on your cash value every year.
Yeah.
And that's the same as getting a check in the mailbox. It
Mm.
just goes into your account and makes that number bigger. And every year that amount gets bigger and larger. And nothing is created overnight, but if you have the ability to look forward 20 years or 30 years, which are going to pass whether or not you want them to or not, whether or not you invest or not, why not invest in something that in 30, 40 years becomes big? My God, the policies I have, the first policy Cindy and I got on Riley and Sam, they're like $5,000 a year premium, right? Which it's a chunk of change, but
Yeah.
for an ER physician, it's not a huge chunk of change.
Yeah.
When they're 60 or 70, every year, it's insane the amount of guaranteed cash flow, right? So they're going to be putting $5,000 into the account, and the account value is going to be going up by 30,000, and you're like, oh, that's a nice return. Now there's inflation and everything, but that's passive cash flow, and oh, I personally have a little goal, David, of every like quarter I look and how much have we increased our family's passive cash flow, and the higher that number gets, the more independence you have, right? And if I want to work a whole lot of shifts, or if I don't, want to take 3 weeks off, I can do that, right? So those are all really wonderful things. So to me, I think that's like the absolute funnest part, and it ain't sexy. No one's ever going to look at the returns on a whole life policy and they blow your socks off, except they typically are comparing them to, right, gross returns versus net returns. They're typically comparing them to stock market average returns instead of real returns. And there's still a spread, but when you take into account that, I'm going a little off track, but I'm gonna run with it.
No. This is fantastic.
Right, the Dalbar study. Have you the Dalbar study?
No, I'm not familiar
So
actually.
Dalbar, they do an annual study where they dive into, I believe it's both mutual and ETFs, but they dive into all the stock market data, and they look at withdrawals and flow in and out of these funds. And with that, they're able to say, all right, the average investor underperforms the market. So,
Yeah.
and every year it's the average, if they look at the average performance of the investor class versus what the market truly returned, there's always a spread. And in most years, it's anywhere from 100 to 300 basis points. Do you know what the spread was last year? So market did, I think, 25, 26% last year, depending on which index you looked at. The Dalbar spread was like 860 some points. So almost 8.5%, right? So from 25% down to 17, 18%. So we all like to think ourselves, I was telling my friend today, I'm like, I suck as a stock market. I always think the world's collapsing. I always think it's going to be bad. And I've said this before, if I would have just shoved money into an index fund and like forgotten about it, I would have been much better. But black helicopters, I see the, death, mayhem, to say, all this crap that's going to happen. But we all do that, right? And we all underperform we shouldn't say all, most of us underperform the market. So if you take the returns that I'm guaranteed to get in my policy, and I compare it, because those are net, those are after costs, those are not taxed if you appropriately, and judiciously, the way you either use the money, withdraw the money, or take loans on the money, they're not that far off. And to me, that certainty, yeah, that's pure fun.
Yeah, no, I love that. Yeah, I definitely follow the conversation. I'll tell you how I think about this. I think we're combining a couple important elements that we should definitely slow down and double click for anyone listening. But when we talk
You
about,
got me into fun. I mean, this is what happens.
I love it. No,
Ask anybody in the ER. Once I go off the rail, it's bad news. Yeah, there's a lot of ass slapping and all.
No, I think that's exactly the reason why we're having this conversation. I'll tell you, like on a very simple way to reduce what guarantees are. When people ask me, hey, what are guarantees? I love what you mentioned there. There is a guaranteed aspect of the growth of the cash values of the equity you own in this contract that is going to approximate and reach the death benefit at the end of the contract. That death benefit is also guaranteed. So what you're saying there basically is, hey, we're riding this curve of growth throughout your life, whether you sweat or bleed or do nothing about it, right? It
And if
is
you're around in 30, 40 years, that curve is getting steep.
I want to be in the hockey stick right when we're up here, my
I want
friend.
to get all
Absolutely.
Al Gore on it.
Absolutely. You're going to have a significant amount of equity. Hey, but let me bring this up to you. If you unfortunately don't get that opportunity, what happens? The people that stay, the
Yeah,
beneficiaries, get
they're
that significant
they're
step
on the
up
hockey
to
stick.
that guaranteed
Yeah,
death benefit.
yeah,
What about, and maybe the theme of this conversation today should be, what about having an asset that works in every scenario? The
yeah,
scenario where you live long, the scenario when unfortunately you pass, you're protecting against and hedging against every scenario by providing liquidity on a guaranteed basis. So I agree 100% with you. Another guarantee that I think is important here, you mentioned the word inflation. What if the premiums, at least the minimum base premium or the minimum premium to keep the policy in force, is guaranteed to be the same at age 30, 40, 50, 60, 70,
yeah.
right?
Kind of like a
You know,
mortgage.
in a world of inflation, we're talking about 30 years fixed debt in a mortgage. But here we're saying, hey, as my mortality risk increases, my premiums were exactly the
Staying the same.
same day one, and they're staying the same.
Yeah,
So, in plain English, 30 years down the road, in my 70s, in my 80s, right? What happens to my mortality is increasing exponentially. My premiums will be what they were back in 2025. And in 2030, 2040, 2050, they're not going to feel the same way that
yeah,
they felt today. So
yeah.
really,
I,
really good
I'm gonna I'm gonna
thing.
hat tip. So our good friend Wade, who at some point we'll have on thing, he talked about this book. It's called like Feldman
Feldman.
Method. Yeah.
Hmm.
And there's a particular passage in it which I read it and I'm like, that is one of the best explanations. And this was from the like 60s, I think, 60s or early 70s. And I'm going to paraphrase a little, but permanent life insurance is the only thing you can buy for pennies, but it gives you dollars, right? So that's the inflation protection, right? Anything that holds value but gives you an elevated value is protecting you against inflation. That's why mortgages, people who want to pay off their mortgage in an inflationary environment, you're probably hurting yourself. And you got to get into the calculate. You can still make that decision because there is peace of mind, but there's other alternatives to you still have that peace of mind, but you have the ability. You're still gathering the more you keep the mortgage and it protects you on that inflation. I'm going to make a side note. All these things, if you're not saving the extra money, right? So people say, oh, I'm keeping my mortgage because it's protecting me against inflation. Every year you should figure out how much money it's saving you, right? So if your mortgage interest is $8,000 and because of inflation it should be $9,000 the next year, you should save that $1,000. If you don't, then the mortgage isn't helping you because you're not taking that extra part and putting it away for your family. Side note. But so Feldman, I'll go buy it for pennies, gives you dollars. It creates instant wealth, but then later on, so as soon as you buy it, you've now created instant wealth in case you die. But then as we get older, it protects our wealth, right? So you have all this protection within it, which is fantastic. Builds a foundation, right? I know you love to talk about the foundational, but it truly is the bedrock, the foundation of a family's portfolio and
Yeah.
balance sheet, right? There is nothing better. And then
Yeah.
lastly, I think this is the sexiest thing, it underwrites time.
Mm, yeah.
And when I read that, I'm like, I gotta think about that, right? And it goes into the only thing we can't guarantee a lot, but the one thing we can't guarantee is how much time we have. And if you have a family, if you've got a spouse, if you have someone that is dependent upon you, um, they want you to be around tomorrow, next year, a decade from now, right? And you think you're going to be there, but you can't guarantee that. And that ability, as soon as you buy a permanent policy, you have underwritten time. You have taken the whole issue of not knowing how much time I have and solved it. you've solved that problem. So I thought that was such a sexy little paragraph that,
But
yeah,
but but let me press on this because I think this is important, Paul. Like what we're talking about is the fact that hey, if the uncertain piece is that we don't know when, but it's not an if, we're going to die at some point,
yeah,
and we don't know how much time. The reality becomes, basically two options. I need liquidity now and every year that I live, and there's going to be a need for liquidity when I'm no longer here. And you're introducing the asset that provides both on a guaranteed basis, an equity or cash value that continues to grow with you and provide that event of liquidity every single day that you own this thing,
yeah.
and the guarantee that that liquidity event will hit at the end by keeping your premiums leveled. This is just, again, a beautiful arrangement, a beautiful idea. It allows you to hedge every scenario moving forward for the need for liquidity. So
Yeah.
guarantees,
And
again, super
and
fun.
walk me through, but if I were to ask how the hell can an insurance company do that, right? It's
Yep,
because their investment horizon, right? And it's,
correct,
yeah, it's
correct.
they're balancing assets, liabilities, and having 50, 100-year investment horizons. Law of
So
large
that,
numbers. They know in 50 over the next 50 years what their liabilities are with regards to insurance settlements. They can
yeah.
probably get it pretty close.
So imagine them understanding a liability profile of the death benefits that they will pay probabilistically when every single year, because they're using mortality tables for thousands of people, because they have ratings where they know, hey, we have these policies at this rating, which means the mortality likelihood is so and so. So they create a profile of liabilities of death benefits they will pay over time. There are also companies that they're not doing your typical behavior of quarterly earnings to keep the stakeholders. They're not driven by short-term metrics. They're in the business of paying these death benefits 60, 70 years, 80 years in the future. They're going to take that liability profile and they're going to match it with assets that create this tightest dispersion between those two lines to make sure that their net amount of risk is the lowest possible every single year. And they're going to buy a portfolio of assets, bonds, corporate bonds, real estate, mortgage-backed securities, maybe some private equity, that is going to create a duration that matches that liability profile, right? In conversation with some of the chief investment officers in these companies, right? They buy combinations of bonds that may have 13, 15-year durations. They may buy some short-term assets. They may buy private equity that has very long duration. And in the net, right, they have assets 10 to 15-year duration that allows them to have a long-term profile and long-term view on how they manage their portfolio to continue to deliver those guarantees. And I think you're going to mention something here, but I want to connect this and I want to bring it to the focus here.
See it.
When you talk about guarantees, you talk about that growth. And the question that comes up, okay, but what does the growth look like? We call that competitive yield in conversations, right? So it is competitive. And I want to double click on that, but I'll let you comment on it.
That's why it's so damn fun is that when you have a policy, you're part owner of the company.
Uh-huh.
So you have all those people working for you, right? It's
Yeah.
it's the ultimate. You've got incredible policy wonks, investment wonks working, and they're putting it they're increasing your family's net worth every month. And I mean the wonderful thing with the company a lot of times we work for, I can log on every month and see tick, it goes up. And I do it every month.
Oh yeah, I track this every month.
Yeah,
I can tell you as a portfolio exactly what my policies did from June to July, July
yeah,
to August. I know exactly what it is,
yeah.
and it's a really. I'll tell you, it's not that David or Paul are saying this. The banks call this ghost income. Ghost increase. They call that an improvement to their income statement. They're not going to call it passive income because they don't want to go into the world where they
Right.
expose this as an investment, which is
Yeah,
not an investment.
not
So,
investment.
you and I are obviously licensed professionals. We're very careful with our language. We're talking about how it feels from the consumer experience to observe these things. The reality is that the cash values are compounding daily and are reported on a monthly basis increasing. And that is something I don't see when I log into my bank account.
Yeah, Tom Wheelwright, the tax kind of guru, he'll write about phantom income, right? So that's why
Mhm.
real estate is so fantastic, right? Because you have the power of appreciation, which you're not getting taxed on, and then you've got the power of depreciation, which helps your current income statement pay less taxes. That's phantom income. It's income that's not taxed. This is another phantom income where uh, again, if you have the wherewithal to look out 30 years, it becomes huge. It comes,
Yeah.
you feed the policies and it becomes good. All this doesn't happen unless you have the dedication and the wherewithal to say, this is important to me. It's important to my family. I'm going to save. I'm going to put it for, you have
The
to have that,
habits.
right?
Yeah.
They'll say you have to capitalize the system, and that is true. No business, no investment, nothing good happens without an initial amount of work and then continued dedication to the craft. But that becomes a flywheel where you're very happy to do it because you see what's happening on the other side of the fence.
Yeah. I wanna throw one more thing at you from what you said earlier, and I think it's the comparison game of like the growth aspect of it. Like I agree with you, and if I could share a simple model on how to think about this, the moment you realize the two variables you mentioned are what will help you properly classify what this is, it'll give you a lot of clarity. So the first thing you said a few minutes back was, hey, people will constantly compare what is happening internally to their policy to their investments.
Yeah,
The moment you actually listen to what we're telling you is not an investment, you'll stop comparing it to your real estate performance, your equities performance, your business performance. It is not an investment. We cannot compare whatever you have in your perception of equity growth, 8, 12, whatever it is, whether it's average or not, it doesn't matter. You cannot make this comparison because you're comparing apples to pears.
yeah.
Number one. And
Number
number
two,
two,
yeah,
go
go
ahead,
ahead.
go ahead. Uh,
So I was going to segue. So finish your thought because I don't want to pull you away
mm.
from where.
No, I would say that that's number one. So what are we saying then in number one is, hey, you need to compare this to other safe liquid assets. That's where this thing actually lives. The only reason that we talk about guarantees being a foundational asset is because you have to realize this. This asset does not introduce risk to your life. There's no way to roll back cash values. The cash values are not going to start decreasing. You're definitely so because of that element of it, we need to compare it to things where we store cash. If we think about the living benefits that are safe and liquid. And I'm talking about high yield savings accounts, treasury bonds, CD, places where we store money that have safe and liquid. So if you ask me, hey, if you tell me, hey, David, what is the comparison here? Now we need to understand how to compare that because while you can get a CD right now for 4% or maybe a treasury, or you're not getting CDs today for 10, 12,
No,
15% typically, right? As a matter of fact, when we had ultra low interest rates, we went through 15 years of no yield whatsoever. There were not such a things as high yield savings accounts, right?
correct.
If you own life insurance in 2015, 10 years ago, you were rock and rolling with the growth, the guaranteed growth on those cash values, whether interest rates were up or down.
Yeah.
This is the other part that I think is dismissed. The guarantees of this asset work whether interest rates go up or down, whether there's volatility in markets, whether taxation increases or decreases, whether inflation increases. It's a way to hedge uncertainty in the future. And you said it perfectly there. The way to think about that comparison is to realize that everything you see in life insurance, because there's no deals in the life insurance industry, is
None.
net.
Yeah.
It's a net number. Net of taxes, net of fees. Everything you see everywhere else in a commercial bank, a savings product, safe liquid, that they're gross. If you go get a CD at 3.5%, you're not getting 3.5%. You're getting 3.5% minus fees, minus taxes.
Taxes.
The moment you understand the way their life insurance companies are performing, it starts to shift your mindset to like, oh my God, this might be the most competitive yield across time that I could get on any other asset available to me.
So I'm going to jump off to the next fun thing is that, and it's connected to this, the fact that it's safe, it's guaranteed, um, never goes down in value. For those who get into retirement, it's the peanut butter to jelly, right? It's the Batman to Robin. It makes your retirement funds, your investments, your 401k mathematically proven. Wade Pfau, who's
Mm-hmm.
if you ever want to read a book, retirement
Yes.
researcher, he's got a great white paper. If anyone wants it, I will send it. Just put get a message to me and I will send it to you. That proves
This one
your.
is great too, by the way.
Yeah,
Yeah.
absolutely. So having life insurance, having cash value available to you as a volatility buffer, and I think that deserves a whole nother show, because we can really
Yep.
get into the weeds. But having that volatility buffer, so on years that the market is really down, instead of taking from your investment account, you take from your cash value. He'll also talk about the use of other insurance products, annuities, which we don't talk about. I think it's a great thing to talk about in the future. But if you use those, so you can take a $2 million, say you have $2 million saved up in your 401k, and safe, 4% rule will tell you can pull out $80,000 a year, right? Live off the interest, live off 4%. Over 30 years, you're nearly guaranteed not to run out, not perfectly guaranteed, but nearly. Well, instead of living off $80,000, you can take that same $2 million, and instead of if during that earlier period you had not put all of it into 401k but done a whole life insurance policy, and then at the end you'd buy a annuity, that your spending increase goes from 80,000 to much higher, sometimes 50 to 60% higher, and it also gives you a guarantee of you categorically won't run out of money, and it leaves a much bigger death benefit. So not only do you get to spend more money, you have the permanence, you have the guarantees that you're not going to run out of money. The day you die, your family's going to have more money. It's like, why in the hell would you not want that? And people are so fixated on the number in their investment accounts, and it's like, it's not always that number. That number isn't efficient. You want to make your retirement assets to work as efficiently as possible. And that takes tax planning. It takes all your team members, right? You need good tax guys, good finance guys, figure out what buckets, insure, taxable, non-taxable, all those things with your investments. But a permanent life insurance policy, from an actuary standpoint, adds, right? And we look back at the pension system. There used to be two ways of people would save money, and then people would have a pension, right? So there was actuarial science, and that means that I'm going to generically say this, but if you die early, you're not penalized. But those who live longer, because those people have died early, there's mortality credits, and that means that from a standpoint, this actuarial insurance used to be a pension. Now kind of we're sliding in it's not exactly one for one, but we're using whole life as somewhat of a pension. That benefits your savings, which is, in the old days, 50 years ago, 60 years ago, people didn't have 401k accounts. They didn't exist, right? So they would have savings. But a 401k account, an investment account, is buffered, and it's made better. Peanut butter, jelly. I'm going to go with insurance being the peanut butter. I like peanut butter. Jelly's
Yeah, I
really
mean,
shallow.
we need to dedicate a chapter, not a chapter, an episode to this conversation, because I think there's a lot of things, I always think about that idea. Everyone operates that conversation on a risk parity paradigm. I have some risk profile where bonds and stocks create a balance between growth and security. And nobody's really considering that there perhaps is a better alternative to driving growth and still investing by having a more proper foundation. One of the conversations we constantly have with clients is, hey, what would happen if you replace your bonds with a guaranteed contract like life insurance that has the same income strategy, right? The same asset class investment. Corporate bonds is where you'll find professionally managed by one of these companies. But number one, you're now in conjunction with a multi-billion-dollar company with a professional staff managing this, and they're fully transferring the risk of the volatility in that market to give you stability with the same guarantees, growth, death benefit. So you could replace in your risk parity those bonds with a life insurance contract, add
Yeah.
stability.
It,
The
yeah. Keep going. Sorry.
No, and the other thing I was going to tell you, you mentioned all those things. It takes tax planning. And I'll tell you, I'll go to extreme. Do you think that people that did that and retired in 2007 were expecting what happened in the great financial crisis? And how do you explain so many baby boomers going back to the labor force after doing all the right things, still dealing with risk of sequencing of returns and all the things we talk about that we'll probably talk more in the future? Sometimes it takes luck. And what if we can transfer some of that element of luck to more certainty by replacing with certainty today, that uncertainty in the future, adding stability? It is mind-boggling to me. I think the statistic is like Americans made $70 trillion, Paul, since 96, 97, all the way to 2007. only the top 3% of the country made it to the millionaire state, right? The status, right? So significant amounts of income, but because we don't have a way to capture that income in a way that gives us a proper foundation, there's so much stability. And in that cohort of baby boomers, 70 million, 72 million people in the country, the number one fear continues to be running out of money during retirement, outliving the
Yeah.
retirement funds. It is, it
The
again,
biggest fear out there.
it is proof in the previous generation that we need a different way to engage in this problem.
I read a stat today, and I don't know. I tried to get the website didn't give the reference behind it, so I'm fearful of believing it. But they said less than 25% of physicians retire with greater than $1 million in their portfolio, which
It's
I
mind-boggling.
still have a hard time believing, but I think I do think it's entirely possible. Um,
Yeah.
yeah,
Let me throw this at you really
yeah,
quick because I think it's important. If you're listening, just hear me out for a second. Think about the following. Imagine what you earned last year, and now try to average your earnings over the last 10 years. If you made $100,000 last year and it's around $100,000, that means that in the last 10 years, $1 million went through your hands. Whether it's business, whether
right.
you were a doctor or engineer, it doesn't matter, right? $1 million. And the question I have for you is this. If the deal of a lifetime came across your desk and you understand how to do it, you understand how to manage the risk, you can buy the ideal company, you can buy the ideal stake on a deal, whatever it is, right? It comes to your desk. What's the biggest check you can write right now to guarantee you're part of that deal, to guarantee you take that opportunity down? And I can tell you, most people that I ask this in live events with you and many places we have this conversation with clients, the answer is less than 5% of everything I earned in the last 10 years.
Yeah,
That's the most common answer. The answer in plain English is that check is not big enough.
yeah,
So whether
yeah.
you're a
That
doctor and you have really large income or you're a regular professional, the problem is the same. We're not retaining that money because we don't understand that the savings environment that we're talking about through benefits is not maximizing that opportunity.
and and to your point, there's investments and then there's opportunities. And I actually asked this question to Kim Butler on a
Hmm.
Truth Concepts webinar this week because we were talking about the benefits of having that cash value, and you can invest or there's opportunities. I said, well, what's the difference? And her great succinct answer was, an opportunity usually has more zeros. Like,
I
yeah,
love that.
yeah. I'm like, that's perfect, right? And to have that ability. And I mean, I know you mentioned bonds, right? As this is a bond proxy, and most people look at, right, they're most people's investment accounts typically aren't entirely in stocks. The young people typically are, but as they get older, usually their advisors are going to push them into some sort of a mix of 70-30, 60-40, right? 60-40 was the old standby. For the first time, right? Fast forward to 2020, and those when interest rates were getting hiked, the 60-40 portfolio got crushed, right? Because your volatility buffer, which was normally bonds, right? So normally people would say, I accept a lower return on bonds of 3 or 4% because it's not going to be volatile. It's going to reduce the volatility in my entire portfolio. So by accepting a less of a gain, but decreasing the overall portfolio volatility, it's much better in the long run. That didn't work. And
Yeah.
interest rate environment, inflation's out there. I mean, we don't know, right? We just don't know. But
Yeah.
the great thing about this is I don't, with with a bond proxy, insurance rates don't affect insurance, or the interest rates don't affect me because I don't
It's
have
a
a
risk
large
transfer.
amount in bonds. Yeah.
It's a risk transfer.
Yeah.
We probably don't need to go down these weeks, but
I
it's
know.
fascinating. Like it's
We haven't
really
even gotten to all the
interesting.
fun stuff, and
Hey,
we're
we are going where it's fun right now. But I'll tell you,
we're
I had
we're we're a insurance thing, and we've not even talked about infinite banking. Holy shit, David.
I'll tell you, I had this conversation with a client recently. Actually, it's funny because we were talking about the same thing. It's like, hey, think about 2020 where that risk parity paradigm was kind of not there. And like if you ask people questions, deeper questions like, hey, how have you been tracking in the 2010s how corporate buybacks have affected the relationship between bonds and stocks when all these corporations take on debt and they buy their own stock. Is that going to change the model that we've assumed works forever for many, many retirees where I'm just going to start 60/40 and then I'm going to shift that again down the weeds, but I asked the question because the answer that I want to hear from people is, I'm not close enough to this conversation to really know even what you're saying, or I'm not following. And that inherently reminds them I'm taking on the risk on, even if I have a professional supporting me, on taking the risk on the results of this if I'm not close enough to understand how to underwrite this behavior. Most people can, most professionals don't, let's be honest. The beauty I see on this conversation you have here of risk transfer through guarantees, through a competitive yield, is that is, again, uncorrelated and completely mute from all those variables we're talking about. So consider that as a way to educate yourself.
Yeah.
Absolutely.
I mean,
Well,
we're still on fun.
let me,
I think probably time-wise, we're gonna, this is turning into like a War and Peace, a Tolstoy-esque thing. There's other fun things, right? There's policy loans. There's the ability to use it for investments and really, increase your family's net worth. And then there's the whole other thing of family banking, infinite banking, which I think deserves some separate attention on their own.
yeah,
But
agree.
if you look at all of those, we've talked about liquidity, we've talked about privacy, we've talked about the guaranteed, we've talked about it being competitive, the competitive yield, we've talked about, well, we're gonna in the future talk about the loan provision, and getting loans is really easy. It's 5 minutes of paperwork, and 2 days later, 3 days later, there's money in your account, right?
Yeah,
And we talked about the not fun things, right? The
yeah,
right, which are again probably the most important things. Insure, the thing I love about our conversations is I think when I look out into the universe, and I consume a lot of the stuff out there on insurance and really respect a lot of the people, but a lot of them are always just looking at either infinite banking, right? Using it to purchase vehicles, all great utility things, but I'm going to avoid dropping the F-bomb. They're not what's important. The protection, transfer of risk, that's what's really important. And I'm going to circle back to what you said earlier. You have perfect transfer of risk, but you also have all these other utilities of this wonderful product, and they're not king of half-ass. They work as good as anything else.
yeah,
Oh yeah, it's just
yeah.
I can go on and on.
I'll give you the perfect framework for this, and we'll make it a part two because the way I talk to people about it is like, hey, once you start to understand and you go down this rabbit hole of educating yourself, what you'll find is that you'll find benefits and reasons in general why to put a certain amount of your assets or a significant amount of your assets, I would argue, in this asset class in life insurance, and then there's reasons for using it, leveraging those living benefits.
Yeah,
Borrowing against it may be one of them, but the reality is that it's pristine collateral. What Kim said, I think I love it. I heard her say this before. What is the opportunity cost of having the most pristine collateral or guaranteed access to your liquidity in opportunities you cannot see right now? I think of Buffett. There's a reason he's sitting on 30% of his balance sheet
yeah,
in treasuries. This man is thinking of something that I don't think he's timing the market. I don't think there's a reason why accessing liquidity on a guaranteed basis is valuable. The golden rule. People with
yeah,
the money make the rules. So we've talked a lot about some of these protections, these risk transfer. These are reasons to make this asset a meaningful part of your strategy for accumulating liquidity or even future income in a place like retirement, like you've brought up. Competitive yield. The guarantees make all this possible. So if I can recap one last thing, Paul,
yeah.
is this.
Bring it home.
This contract having guarantees makes everything we've talked about possible. And it's not a gimmick, it is classified properly as insurance, a protection vehicle that is not an investment that will guarantee your access to liquidity whether you're here and every year you're here until you're no longer here, and your beneficiaries will again still have that event of liquidity. That is a risk transfer that you and I appreciate because we love the people we have around, and we also want to be in an abundant life to be here fully present every year of our life. So if that sounds like something that's attractive to you and you want to bring more certainty to your life, we cannot encourage you more to educate yourself about some of these benefits we're talking about. I love the framework of not so fun all the way to super fun. And I think in our next conversation, we should talk more about, hey, what are the reasons to use this? Now
Yeah.
that I understand reasons to put it, how are you talking about using this in a meaningful way to make this asset
And
relevant for your life?
I almost think, we can bust out some of the calculators, have a little bit of fun. We can probably
Yeah.
give a couple real life scenarios, right? I'll
Yeah.
more than happy to share some current investments that we're doing, and I think that'll be fun. It'll be a little
Let's do
bit,
it.
yeah, a little bit, nuts and bolts. I think people are probably, you guys talk a lot. Let's see some numbers. There's the balance, right? You can. I'm much more. This conversation of the power of it, I think is meaningful, and I think it creates the gravity which really, I mean, this should have, and you can do the other stuff, which is we use on a, let's say, not a daily basis, but every month we're using our policies
Yeah.
to help our families. So yeah, look forward to those conversations. If anyone has questions, comments, leave them in the thing. If you have a drink suggestion, I think we're going to make one of those fancy. There's a couple gin drinks that I've got to make some rosemary syrup, so I think that'll be next week's. And then reach out to us. We'd love to talk. If you want to talk to both David and I at the same time, we will arrange that. If you want to talk to either of us, our information is below. David, it's been a fantastic conversation. One of these days, we probably got to we're gonna have to get a studio where we're both sitting in club chairs.
I'm already arranging it, brother. Don't
Yeah,
you worry.
yeah,
Yes. I love that idea.
outstanding.
Pleasure, man. Have a great evening. We'll see you next week.
All right, brother, take care. Bye bye.